When we see the definitions, when we see the description in the slide, it makes things way more clear. For the internal funds, it says money the company generates on its own without borrowing or selling ownership. So, in fact, when you are seeing this description for internal fund, you get immediately what are internal funds, and also you get what are external funds, because somehow it is telling you borrowing is considered external fund. It is telling you selling ownership is considered external fund. But internal fund is the money that generates itself. For example, when you have high income, it is considered internal fund, because the source of that fund, that money, is the operation of that firm, that company itself. We don't need to get money from outside. And in the next one, it tells you external funds, money the firm raises from others. It is not itself, either from lenders or owners, as we discussed it before. In the middle of talking about internal and external funds, what does depreciation do? How can depreciation can be related to the topic of internal funds and external funds? But it is connected. Remember, that's correct, that depreciation is not a cash payment. We all know that. We have learned it together, and we have done activities, exercise, and we noticed that it is not a cash payment, but it is an accounting expense. So, what happens when it is an accounting expense? It reduces reported profit. That leads to lower taxes. Okay? So what does it mean? It means that no cash leaves the firm and the money stays inside the business. So that's the reason it gets related to the topic of funding. And now I'm asking you, do you think depreciation charges that now we notice, it is somehow related to the topic of funding, because it makes the company, it helps the company pay lower taxes, so the money stays in the company, and that's the reason they consider it a source of fund? What you tell me, is it considered external funding or internal funding? If you need to think about these things to catch up more time, just stop the video. The great thing about having something recorded is that just stop the video, do the search, check the web, reflect, and in that way deepen and deepen your learning. Yes, it is internal. Internal funds and depreciation charge is something that companies many times count on that, because it's some sort of, for example, discount you are receiving, and you have that money and you can plan on how to spend that money. And now I'm sure you understand this page in front of you 100% perfectly. Internal funds themselves classified in two different categories. First, and the most important one, retained earnings. Two, depreciation charges. We talked about depreciation charges and how you can quantify that and predict that, and also retain earning. Here, to understand it better, I provide you with an example. A company reinvests its own profit back into itself. So that's internal fund, because you are not spending all the profit you made somewhere else. You are gonna create a channel back to the company. So it is considered internal fund. So the example, if a company makes $10 million and pays $4 million in dividends, the remaining $6 million is retained earning, and it is considered internal fund. So when you are reading some reports and they are referring to internal, external, or that type of thing, now you notice that they are not as complicated as they seem. They are way easier to understand them. When it is talking about how, for example, the source of funding for buying that machine is just depreciation charges. Now you have an understanding for that. As a financial manager, you can contribute more to the process of decision making. Remember, my friends, retained earning is different from the profit that you have made in the company. They are related to each other, but they are different. As you can see here, maybe the company has made 10 million. They have given 4 million to the shareholders, and 6 million is the retained one. If the company make $100 million per year net profit, but they spend all the money in areas that are not related to the company, they spend it for anything else, the internal fund is zero in this situation regarding retained earning. Maybe they have depreciation charges or that type of thing, but retained earning needs to be from the profit that has not been shared with the shareholders. It gets back directly to the firm. For the external funds, it's easier because we are way more familiar with that. So I have put 3 classes here. First, loans. It's external fund. Many times when we want to do things, the main source of funding that project, plan, or anything is getting loans. The other one, selling bonds, that in texture, not a structure, in texture similar to loans. We always need to deal with lenders. And the other one, the last one, is selling company stock, selling the company ownership, selling the company equity. That in fact, you are going to get partners in your system, in your company. Here you see a summary of what we discussed. And let's review everything together. And by the way, you should have a very good understanding of the things that we are reviewing together now. A refresher. Internal funds are monies generated by firm. The source is firm. But here after that, it is specified that retained earnings, profits kept in firm. So they become source of funding. The other one, depreciation charges, they are not cash pay, but they help you keep the money in company. External funds loans, selling bonds, and selling stock. Another thing that I want to tell you, since the material you are tackling at this phase are at the managerial level, high level perspective, you don't need to get involved with the details. For example, in the slide, you are seeing, for example, it is talking about new stock, treasury stock, shares previously repurchased by a firm. At this point, we don't want to get involved into that details. If you are interested, absolutely go and enjoy it, and it's wonderful area. But the reason I'm passing them, for example, I'm not describing the situation or that type of thing, because it is not the focus of this course. The same way we passed the topic of tax quickly without getting into the details, because we are not accountant. We just need to have that general points about tax. And did you notice how we used those tax points we discussed in that chapter in this one? And we are going to use them. We are going to use them in our analysis. So my point, if I'm passing them, it doesn't mean they are not important or they are not good or anything. They are just not related to our points in this class. If you are interested, go for them, enjoy them, and for sure they create value for you. And the last point, need to maintain balance between debt and equity. And now I have a question for you. Tell at what situation you stop the video and try to answer that, because I'm quickly gonna pass it. It is just some sort of reflective time. In what situation you never want to sell the ownership of your company and prefer to borrow money? Just think about that, and your answer would be very enlightening, because it would make sense for the most of the time that companies decide not to sell the ownership and they go to borrow. So when you are coming to a set of conditions, to a set of requirement that specifies when you borrow money for your own company and when you sell the ownership, it's going to be the same case with most of real cases with the companies. So have that confidence to get the basic answers to the basic questions with that approach, because in that way you will resonate when we check the answers together. They are not going to be some sort of alien answers that you are going to learn from them. If you have already generated your own answers, and when you see the similarity between the analysis and that type of thing, apart from the fact that you are not gonna forget them, forget about the fact that you don't need to memorize anything or follow any instructions, because you notice that instinctively you have the same answer. But the main point, I'm telling you, apart from all these advantages, you will get confidence. As the last topic we cover in this video, we have cost of funds. And this one is almost a new thing. And the reason I'm saying almost, because I always keep some space for your speculation. So We have talked about time value of money and the interest rate and all those things. So of course, funds have cost. They are not for free. And the cost of borrowed money depends on many factors. And again, don't memorize things. Just consider when you want to finance your new car, what options the lender consider to specify the interest rate on financing your car. Exactly the same thing here. Firm's financial strengths, your credit report. Ability to repay. Debt's duration, if it is 5 years, 6 years, 10 years. Whether debt is secured by collateral or not. So all of them are common sense. Another thing that we have about cost of funds, because you for sure not financing your project only from one source. There may be multiple sources for that, including internal funds, external funds, the ones that we discussed together. So here we have a new term, a new concept, weighted average cost of capital, that we are going to discuss it. Weighted average cost of capital. For example, for one portion of the capital we have the interest rate of 2%. We have also interest rate of 13%. We also have internal funds. What about them? For example, we have retained earnings. How we should handle all of them have cost. None of them are free. Let me make it to you crystal clear. Even retained earnings have costs. Why? Because of the opportunity you lost because of keeping the money inside the firm. You could have invested that money in other cases, in other ventures, or you could have put it in a saving account in your bank. So there is always expectation for all of these money that we are gonna talk about them.